Hey everybody, Annie Meller, joined once again by credit expert Ivory Becker, talking today about what impacts your credit score.
Absolutely. So there are several factors that create that number you see when you pull your credit report. The most impactful factor to your credit score is payment history. And I think most people are familiar with payment history. But there's a couple things about it that you definitely want to make sure you're aware of. When it comes to payment history, an important thing to understand is that your on-time payments are just as important as any negative history on your credit report. And I think that's something that people often forget.
Let's say I pay off an account. I mean, how's that going to impact my credit score?
Sure. So only open and active accounts are going to impact the credit score. So once you pay off and close an account, it's no longer going to factor into your credit score, with the exception of any late payments. Unfortunately, late payments, they follow you.
Yeah.
Now, the reason why it's important to understand the impact of closing an account on your credit report is because average age of open accounts affects your score. So if that account that you paid off and decided to close was 10 years old or 15 years old, whatever, it's going to now adjust that average age of accounts on your report. So if all of the other accounts on your report are 3 years old, your average age has now shrank.
That makes sense. So the difference being paying off an account doesn't necessarily mean closing it, but obviously closed-end credit, when you pay it off, it automatically closes.
Right. Things like loans are going to automatically close once they're paid off. Things like credit cards are going to remain open unless you close it or that creditor decides to close it because of inactivity.
All right. Well, let's talk about utilization then for a little bit here, because that, I would say, is another pillar of your credit score and what has an impact on that. What should my utilization look like for an optimal picture?
Sure. Let's talk about where utilization is really looked at when it comes to the credit score algorithm first. So utilization is heavily focused on credit cards. Now, it does look at loans, but typically you're only going to be penalized if your loan balance is greater than the original loan amount.
Just the math in my head to make that one work is how?
Student loans.
Oh, yeah.
So
Interest.
think about that.
Yeah.
When they tack on that giant chunk of interest and all of a sudden you
Yeah.
owe more than the original balance, you can see some drop in the score from that. With credit cards, it's very much looking at your balance versus that credit limit. If you are maintaining a low balance long term, you're going to have a higher credit score. And it is a moving target, right? Your credit score is constantly updating based on changes to your credit report. So if 1 month your balance reports as maxed out, you have utilized the full credit limit, you're going to see a drop in your credit score with current algorithms.
Yeah. So lower utilization, better credit score as a general.
As a general rule, essentially you want to think of the algorithm as saying, can this person utilize the debt that's extended to them responsibly, right?
Makes sense.
If you're given $100, are you keeping some of it and saving it, or are you using it all and going on a spending spree?
Cha-ching. All right. So we brushed on this a little bit earlier about the age of accounts. Let's talk about brand new accounts. We're talking inquiry level here. What is the impact on my credit score?
So when you initially open an account, it's going to adjust the average age of open accounts to be shorter, right? That account's brand new. As that account ages, it's going to have less of an adverse impact on your credit score. Similarly, as you have payments accumulate, that's going to help your score as well. Think of it this way. When you get that new account open, the credit score is like apprehensive. Are you going to pay on time? Can you handle this new debt? And then once you prove, hey, yeah, I'm responsible with that, you're going to be rewarded when it comes to your credit score.
An example we were talking about earlier, because I know sometimes you want maybe the best rate available out there. Maybe let's call it a mortgage even, or even maybe a debt consolidation, and you have X rate and you're like, hey, there's a better rate. I'm going to refinance. How is this going to impact my credit score?
So think of a refinance as the closing of an old account and opening of a new account, right? So it's going to affect things exactly the same way. And we get that question a lot because we'll see it quite a bit with auto loans, for example. So that is going to adjust the average age of accounts on your credit report. Now, if you're moving balances from revolving to a fixed product like a loan, you are going to see some positive benefit there, even if you've adjusted the average age of accounts to be shorter, simply because now you're moving those balances from potentially high utilization to a fixed loan. Right? And that fixed loan, the algorithm expects that these are the payments that you make on a monthly basis. It's amortized typically, and at the end of the loan term, it's paid off, right? So you're not adversely affected with utilization in the same way.
Well, and I guess in that same token, it opens up because now you have more credit available to you that you are not using.
Exactly. Exactly.
That sounds like a nice win all around.
Just don't close those credit cards.
Yeah. On the note of refinance, we know it comes with that is credit inquiries because I am shopping for that lowest rate, let's say. And so I'm out, asking 5 different lenders for an approval just to, I guess, hedge my bets here that I'm going to get the lowest rate out there. How is this going to impact my credit?
Absolutely. When it comes to the credit score algorithm, I think something that's really commonly overlooked is the algorithm allows for shopping around. Essentially, your credit score wants you to be responsible, right? We've talked about that. And there's an allowance for inquiries when it comes to your credit report. So you're not going to see a large adverse impact from a couple inquiries per year per credit bureau. And similarly, when you're applying for student loans, auto loans, and mortgages, you are allowed to shop around. This essentially means that within a set period of time, you can have several inquiries for that like product, and it will only impact your credit as if it's one inquiry. I'll give you an example. Let's say you go to an auto dealership and you're like, I want to buy this car, but I want the best loan. I want the best rate. They're going to submit your information and they're going to put you in their database of all of the lenders that they have.
I've seen, it drives me insane, but I do know they do this, yes.
Before you know it, you see 20 inquiries on your credit report. Your knee-jerk reaction is to panic, but don't. Because even though you see 20 inquiries, it's only impacting your credit like it's one. So don't be alarmed if you see that. And always remember, it's best for you to get the best type of loan rather than worry about an inquiry at the end of the day.
Yeah.
Worst case scenario, that inquiry is worth probably upwards of 4 points at the most.
That is something because I've heard people panic a lot about the impact of inquiries. And my understanding was it was low, but 4 points is very low.
Yeah, 1 to 4 points is the average for the average credit profile. If you're someone who has limited to no credit history, it's going to be a bigger impact simply because there's no other data for your credit score to be based on.
Do your credit inquiries fall off the report?
Yes, great question. So you're going to see credit inquiries on your credit report for 2 years. They only impact the credit score for 1 year.
Oh, that's like no time in the grand scheme of what is credit. So it's good to know.
And think of all the positive payment history, everything else you have going for you on your credit profile. Even if you have an inquiry, you're bound to make up the loss of the couple points pretty darn quickly. Something that's often overlooked when it comes to the impact to your credit score is the credit mix. And really, that's just looking at what kind of accounts do you have on your credit report? What's your history of being able to responsibly pay different types of accounts like a credit card versus an auto loan? And a mortgage is seen as a very responsible type of debt.
Yeah. Well, you consider the payment and the length of that one. Yeah, that makes sense. I think this has been a great overview of what's going to impact my credit score. So keeping in mind your payment history, how you're using your accounts, the type of accounts that you have, and of course the age of your accounts. I mean, did I miss anything there?
And inquiries, things like new credit and inquiries.
Awesome. Well, it's been great information today, learning about what impacts our credit score. Ivory, thank you so much for coming in, teaching us all about this. Hopefully you guys learned something here. And if you are interested, we do have other videos out there and available to learn more about how your credit works. But that's all we have for you today, and we'll see you next time.